Hello dear traders, welcome to this video. I wanted to produce a video like this for some time. I mean, it doesn't really contain any new information, but maybe it's helpful sometimes also for the new subscribers to be reminded of the lingo. So as a matter of fact, over the last years, we kind of created our own language regarding the market causality. Yeah. So this shouldn't be really new information. But let's go through this. So SM, of course, stands for the smart money algos, the price controlling algorithms. DM stands for dumb money, so the price takers who get position hunted, stop hunted. PB stands for position bar. Okay, so in the chart when we have, well, let me show you an example. Let's go here to dollar yen, for example. Okay, the position bars, which are shown here in the histograms, and show you the dumb money positions which are in the market and the ones which were in the market. Okay. Medium term stop, MTS. Yeah, let's go to pound Aussie here. Okay, you see that in the block also. These are the medium term stops, those green lines. They get hunted, as you can see here, boom, boom. These allow for many nice trades. They are dominant. Okay. LTS are the long-term stops. Okay, these are the pink lines, like this one here, which can be found especially on the higher time frames, and where eventually the market will reach towards. STS, so short-term stops. These are those blue and turquoise lines on the left side of the y-axis. Okay. OST, option strike targets, these are those signals like here in Euro Aussie, which got filled today, which show you accumulations of option strike prices which eventually get taken out. If there's no squeeze in the way, these will be taken eventually. OGZ, order gap zones, these are those gray areas here. These are zones where the smart money would like to fill open orders. Okay, it's not a dominant factor, but we can see, for example, that often the price does pull backs towards those levels and then retraces exactly from those, etc. Very helpful tool. Okay, let's go back to the list. Position hunting, of course, that's when the smart money tries to push the dumb money into drawdown, which it does all the time. Stop hunting, so as shown, for example, with the MTS, that's when the smart money wants to touch the prices where the dumb money stops accumulate, and therefore those get kicked out of the market at a loss. Pricing in position bars, so counter moves, that's when we have, let me see, yeah, with a recent example here in Australian dollar. So you see we had shorties in the market, so they made an up move in order to price in those shorties. So that doesn't mean that, you know, they will go all the way, but at least they need to make a move against those position nests in order to make sure that if there are tight stops, these get touched, and also if the dumb money is not very confident, they close in a loss. Yeah. Okay, so pricing and use plausibility. This happens when we have, let's say we have US unemployment being published. Okay, let's say the unemployment is lower, so the dollar should get stronger. That means euro dollar should go down. If the dumb money is long and therefore the smart money pushes euro dollar down, that means a price in the economic news plausibility. We know that often if, let's say, we have the same news results, but then the dumb money is short or placed correctly, the smart money will simply push the price up. So we'll disregard the economic plausibility. That's why you cannot just trade on the basis of any economic theories. MK, market causality. I'm German, so it comes from Marktkausalität. H4 bands, these are the bands on the 4-hour chart where, you know, we have the reversals on the 4-hour chart. We know that 4-hour reversals are the reversals away from those bands. Day chart moving averages are the moving averages on day chart, which often get cleared. We know that. IR stands for inner range. So let's say, give me an example. Here's cable. So this stop hunt was IR, so inner range, because the price has been there already. Okay. Whereas when we see squeeze moves, often they reach for outer range areas, like here in dollar yen. Okay, so this is out of the range on the 1 hour chart. Okay. Failed reversal is when we have a 4 hour reversal, but it doesn't come and goes in the opposite direction. Squeeze line, that's of course here this very important indicator. Okay, the net money indicator. These are the squeeze lines, and as you can see, like they are very, very important. When the red squeeze line is up there, then we're gonna have an up move like here in dollar yen, and vice versa. If the green line is up here, we're gonna have a down move. So squeeze move is a responding move. Median, these are the medium lines which sometimes act as the actual support and resistance levels. They are not the dominant factor, but you can still see them here on the 1 hour chart and also on the M30 chart. Damani tolerance, the Damani position bars which are allowed to get temporarily into profit. We know sometimes that happens. Let's say here cable right now, so it goes up in order to take those stops. And you see there are a bit of longies in the way. Those are within the tolerance, so they're allowed to win because they prioritize taking out those short-term stops over pricing in the longies. Yeah. Meter levels. These are the meter levels which are explained in the video course, which are not public. House lean whipsaw. That's when we have like this typical move in both directions. Here's a good example. Euro pound recently. You see, bam, bam. Hunting short-term stops up, down, down, up. Okay, so this is a typical house clean. You often see that with interest rates announcements. Yes. Fake support resistance. Yeah, that's. Let me see what I see here. Yeah, this for example is fake support here in Australian dollar. You see, so it draws in the support 1, 2, 3, 4 lows, and you think this is like a bullish signal, but then it boom breaks this target where people place their stops, where the longies place the stops below the low. Okay, just to be taken out. Fake support, fake resistance is the same thing the other way around. So very common to see that in the charts. Yeah. Like here in cable, you see this is a bit of fake resistance. So 1, 2, people think the price 1, 2, 3, people think the price bounces from this area, and what happens? Boom, it gets cleared. Grail pattern, reverse grail pattern. This is not something complicated. It's just like here again in cable, you see like this A pattern, or if it's the other way around, like a V grail pattern. Which, because it looks like a grail, this looks like a reverse grail. Okay, grail just when it goes up, down, or vice versa. Plateau pattern. Plateaus are areas where we often have stops, like here. Let me see, let's go to Euro Pound. You see like here, this is a plateau. Often we have stop accumulations there. High bias trades. The trade which ticks the boxes on the list. Yeah, so if we have like a very clear trade where everything aligns, that is a high bias trade where we risk more. Medium bias is where most of the boxes are ticked, and then low bias where less than half, let's say, are ticked. Of course, the lower the bias, the less you risk per trade. Okay? So I hope this helps regarding the lingo. And yeah, if you do not understand what we are talking about here, then of course you need to study the market causality. All the best.